Welcome to the daily update, where I'll go over the action in the market for Friday, November 14th, and we'll see how things look for Monday, November 17th. Well, it looked like it was going to be a pretty negative day. We had a gap lower open. It's like, okay, here we go. But then we hit some support. We were able to bounce up off of that and made a pretty gallant try at recovering from that. Hit overhead resistance and then ended up closing down just a little bit. So, again, if you just look at a daily chart, it may not tell you as much of the story of what happened during the day. That's why I follow intraday charts. Now, we're still maintaining support above the 50 period moving averages. So that's holding for right now. We're negative in the short term because we're below the 20 period moving averages, but we're positive still in the intermediate term above the 50s. And of course, we're positive in the long term. We're well above the 200s as there's this struggle going back and forth between growth and value, between offense and defense. And so we'll just have to see, even though this is a positive time for the market, there could be some doubt coming in. It's like, well, maybe the market's not automatically going to go up after all. So, and then once that doubt is removed, or at least you get people scratching their head saying, well, the market's not magically going to go up, then that's when it starts to go up. And then people jump in because they have a fear of missing out. All right, so before I get into the main part of the video, there's a thing called the SPX investing program. It's a program I've developed, I manage, I operate. I created everything for it. And if you feel that that is helpful from now until the end of 2025, it is free. Here is the link right here. It's also right below this video in the description. All right, so right at the open, we had a gap lower open. The futures turned quite negative, and we ended up opening below S2 at 66.60. So we broke below the 6,700 level, but we set the intraday low right after the open. So we kind of saw the worst there right at the beginning. And then we climbed above S2. We got back above the 66.60 level. We got up above S1. Now, 66.99, you could pretty much call that 6,700. So we were able to recapture that. And then we went positive, got above the unchanged level, and then we hit resistance at the daily pivot at 67.63. And then we just chopped between the daily pivot and unchanged level, and we closed slightly down on the day, down 0.05%, not very much on a percentage basis. And we were below average with volume there. So, as I said before, negative in the short term, positive in the intermediate and long term. Interest rates, we're keeping an eye on those. They're starting to go back up again. And there was some more Fed speak that came out as well. So the NASDAQ and NASDAQ 100, they did close slightly positive. So that's growth, mainly the NASDAQ 100, but NASDAQ also. And they opened lower with everything else, but ended up actually having a slight positive day. And the 50 period moving averages are holding for right now. So Kansas City Fed President Schmid signaled that he is inclined to oppose a December rate cut. So we're seeing some consistency. Going back all the way to the Fed meeting, Jerome Powell said, I don't know about that December rate cut. And then we've heard other Fed officials coming out and making statements pretty much saying that same thing. So for right now, the Fed appears to be more hawkish. And then echoing comments from Minneapolis, Kashkari, who we've talked about before, who said he did not support the October move. He didn't even like that we cut rates back then and remains unsure about December. Again, these are more hawkish. And so the market is like, okay, maybe we're not going to be seeing a rate cut in December after all. There's other folks that say, oh, yeah, we're going to see one. Once those economic reports start coming back out, we're going to see that things are weaker than expected. We don't know any of that at this point. And so I go over this in the weekly video. I look at what does the market think of the December rate cut, and then I go the Fed meeting right after that by looking at the January meeting as well. And I'll be going over that in the weekly video. And we're under 20. Now, on Thursday, when we had the pretty significant down day, we spent most of the day above 20, and that's when things turned more negative. But we closed right at 20 on Thursday. Well, we saw enough of a rebound to at least take the VIX under 20 on Friday. We're at 19.83. Still elevated, still right on the border of being more negative, but at least under 20. and we had another spike. Now there's a 1 day lag with this chart, but after for Thursday's downward move, we got another spike. And so now we're starting to see a series of Hindenburg almond spikes, and I'll show you that chart later on. And then we're seeing a little bit more of a buildup of the negative short-term conviction. The Stochc RSI, which has been here for a couple of days now, it came up after Thursday and it's still here after Friday. And now the shorter term CCI 14, we have a CCI 20 also. That's coming down as well, but it's not extreme yet. And no real change to the scenario. It's just like the December cut is not as likely as previously thought. Not saying no, but not looking as possible as it was just a week and a half ago. The dollar was up, interest rates were up. We're at 4.15% with the 10-year yield. So we want to keep an eye on that. Not in the real danger zone. We get concerned when it gets above 4.5%. We're well below that now, but the trend of interest rates has been to start going back up, and they pretty much have been going back up since the Fed came in and cut rates, as illogical as that sounds. And we're actually still looking pretty extreme here. This could actually be positive for the market. When we get under 25 with the sentiment gauge that we follow, that's when it's like everybody's freaking out. And so maybe we ought to start looking at some positive things. Not sure about that because last spring we camped under 25 for like many weeks there. But we did decline down to 22, which is negative in and of itself. And it also declined down from 24, which was already extreme negative as well. And then another thing is we're starting to trend. And that's one of the different things. Now, lately, in fact, I just was able to close a number of positions in Friday's session of non-trending or market neutral strategies that I implement that I talk about in my program. Still have a few open, but they've all been very successful as we've been chopping around in this trendless environment. Because what I really try to stress is we can make money when the market goes up. We can make money when the market goes down. And right now, we can make money when the market is not trending or more in a sideways pattern, which we've been seeing a lot of lately. But in the short term, we are starting to trend. We're crossing above the moving average, but it's not confirmed since it's still below 20. And I'll show you this chart, but it's negative. And we started to see that a few days ago. It was starting to pick up the beginning of a negative trend. Then we had a solid up day, blew the ADX up. It's like, I don't know what's going on now. Now that we're leaning more negative in Thursday and even Friday's session, now the ADX is starting to pick up that negative trend, but it's not confirmed since it's below 20. And we're still negative with the bias, and that mainly carries over into Thursday and Friday together. And the momentum is negative as well. So we didn't have any economic reports, and I'm not going to be doing the economic calendar now for another week or so until we start getting some economic reports. We don't know really what the whole situation is with that. So there's no charts to show you there. Now here, this is just showing how gold and stocks are both up together 3 years in a row. Yeah, gold's been doing okay, even though it's spent a lot of 2025 going sideways. It's just been recently that it's been breaking out. But we're seeing both stocks and gold going up here. And then valuation, something that we've already known, looking at this particular way of the trailing PE, the forward PE, the CAPE. It's putting all these different things together into like a composite valuation indicator, and we're getting to a pretty high level. Now, if we start to experience some more downward move, valuations are going to be blamed. It's like the catch-all blame for everything, but we've been overvalued for a long time. Now, this is starting to look pretty extreme, more than extreme than it was in the past. But if you look at some of the individual charts that I go through, yeah, we've been overvalued and we've known that. And I talk about it in pretty much every daily video. And I go over it again in the intermarket analysis video and the weekly video. And we have been overvalued, but that's what will get blamed. So we can't really use overvaluation as a timing tool. We can just say, yeah, the market's overvalued. And then we look at our other charts to say, okay, now things are starting to shift off. But even after we've had a decline, we could still be overvalued even if we see some kind of a decline. Then here, we expect global equities to deliver a 10-year total return of 7.7% in US dollars. That's what Goldman Sachs and DataStream are coming up with here. All right, so that's just what they figured out. And then the market cap and earnings, it's very similar to what we've been seeing for quite a while now. You've got the 10 biggest companies that are 41% of the market, and they account for 30% of the earnings. And that really hasn't changed. And then the 3-month realized average stock correlation, it has been low. It was getting to a low level, which could actually end up being positive for the market when it gets extreme. It has been popping up a little bit, but it doesn't mean it's necessarily going to go straight up. Even though we have come out of this is right after the April lows here, and we just shot up really big. But the market's a little hesitant right now. Home prices, just showing how they've been going up and then starting to trail down. This is the year. This doesn't look year over year. This looks at all the months within the year and how prices have been changing there. And then retirees, because baby boomers, of which I'm at the very tail end of that, it's like now they've got all these retirements and their 401ks and pension plans and things. They're really doing a lot to hold up the economy. So it says 2.5 million excess American retirees are keeping the U.S. economy afloat by their booming 401ks and their wealth. So the greater risk in 2026 and 2027 is not that a recession happens, but that a market crash crushes this group's spending. So yeah, even if you're retired, you still want to pay attention to what's going on in the market if you're still bound to investments that go up and down in value. And then here, insiders here, and what we're seeing is a bit of a shift. We're seeing a lot of retail folks, which would be you and I, because we have to do things through a broker. They're doing a lot of buying. But then if you look at the corporate folks, they're doing a lot of selling here. And so it's like, okay, we want to follow what the smart money is doing. So it says, what is catching my eye? This is Timmer Fidelity, is that while sentiment is leaning bullish, now shorter term it's negative, but in the bigger picture, sentiment is still quite positive. Among retail investors and Wall Streeters, corporate insiders, these are the CEO, the corporate officers of a company, they're selling at the highest level since 2000. Okay. They have all kinds of reasons to sell shares, but given the conversation about valuation and bubbles and loft earnings goals, current 2025 to 1 sell buy ratio is something that gives me a pause. So we'll just watch that and see. There could be some insider selling going on. We also watched the announced buybacks. Now that's different. These are actual people in a company that own shares of the company that they work at. Where when a company announces a buyback, that's the company buying back its own stock. And then retail versus mutual funds here. For all of the churn this week, the S&P clawed back to in the week flat, and it was. We gave up the gains, but we were off of the worst losses. The movements under the hood perhaps suggest some risk appetite is getting scorched for the time being. That means the market going up. That's when we're more risk on. But for all the fear, it's not like the sell-off set the index unraveling. So yeah, we've seen some selling, we've seen some buying, but we pretty much ended about where we started this week. And profit margins, and I'll also go through a chart, either this chart or one similar to this. This is what justifies stock prices going up. The profit margin, 13.1%, which is really good. And continuing to go up, that's positive. And they expect continued strength going forward when we start going into the fourth quarter of 2025 and into 2026. That justifies stock prices becoming overvalued in the first place. All right, so here's the chart, and it looked like, oh man, this is going to be an ugly day, but it was enough of a gap, so you had a lot of folks coming in wanting to buy. We set the low right at the open. We came back above S2, got above S1, hung around the unchanged level for a little while. That acts as a resistance level on a down day. We were able to climb above that, but then we started to hit some resistance right about around the daily pivot. We came back down to the unchanged level, back up to the daily pivot, back down to the unchanged level, and closed slightly negative. And not much of a change as we shut things down over the weekend. I'm looking way over here on the right-hand side at the market that keeps trading for a little while longer after the cash market closes. And we are seeing a bit of a pull down here, and we're still seeing red above blue. That means that on an intraday basis, value is still outperforming growth. And they're not really falling apart right now. The bigger picture is going back to June, where they've been trending up. But we want to keep an eye on this. And it's certainly in the shorter term been giving us some concerns. And I'll show other charts like this one. See, even though we tried to bounce up off of the lows here, the intraday growth to value ratio for the S&P, it's not looking all that strong right now. And then end of day growth was unchanged, where value ended up being down. Now everything got taken down on Thursday, where it was more value saw some favor on Wednesday, and growth did not. So growth held up a little bit better for the large caps on Friday, was down less for the mid caps, and down where for the small caps, where the value ended up being unchanged. So we're seeing a little bit of a hit here. After looking pretty strong with the small cap growth to value, hasn't really helped things because the index just continues to go sideways for the most part. But we ticked up a little bit with the small cap growth to value ratio after really coming down after Thursday. This is the one that's causing a little more concern, but the mid caps have been the worst performing index for the last number of months. Trailing off here, going sideways, dropping below the 200-day moving average with the growth to value ratio. This is the one that concerns us the most. It's the S&P growth to value ratio. We were looking really good back in August, fell down below the 50, could not get back above that. Now we're starting to fall down below the 200. This is a market that is continuing to get more defensive, meaning that it's getting ready to continue to go down. Now, we watched this for a while, and I kept saying that. We just didn't see real follow through other than a day or two here or there with any downward moves. And the same thing might happen this time. We could finally drop enough to the point where we start to see these ratios start to go back up. Now, there was a little tick up on Friday, but not much of one there. And we're still at the high end of the rainbow, even though we're pulling back with this growth to value ratio. Still below the 50-day moving average with discretionary to staples. We want this to go up. It's been languishing sideways below its 50-day moving average. Now we did, and I'm going to show you a number of charts where the 50-period moving average held. We saw convergence, not only for the S&P, but a lot of different indexes, including this large cap growth ETF. We opened below the 50-day moving average. We were able to get back slightly above it by the time we close. So this is the intermediate term support that's still holding for right now. So we're looking more negative. This is the short term. See how we're crossing above the moving average? It's starting to show a trend now, but it won't be confirmed until the ADX crosses back above 20. But we're negative because the red line is above the green line. The red line's going up and the green line's going down. And we're not quite there yet. We haven't quite crossed above the moving average yet with the ADX in the intermediate term, but it is negative with the red line above the green line. And we were below average with volume here. Now, what was interesting is we had a pretty significant down day on Thursday, and we were above average with volume. That's a little bit of a concern. And then we kind of chopped around and ended up flat for the most part, and then we were below average with volume in Friday's session. So we're still looking more negative here. We did have a gamma flip negative. This is an attempt to figure out, okay, what are we leaning more positive or negative when you look at the gamma? That's one of the Greeks that goes with options. It's called gamma exposure. And we have to get back above the 67 level to turn this back to positive, to get up into this green area. Now we're down in the red area here at 67.34. And we do see some possible support here that we've broken through. It's 64.40, 64.50, 64. So I'm not sure. Oh, 50. I'm not sure what these numbers are here because these don't seem to be lining up. But we look for when the up and down column crosses with the rising blue line here. And this is support that was broken. And now we're going to see if we can get that back or if we're going to continue to head down negative even further. Then this is still more big picture. It's the euphoria meter. And I'll also be showing this in the weekly video. We're still quite positive overall. This is more of a composite of different sentiment gauges together. It hasn't gone extreme negative like the daily charts that we look at. But we are seeing some fear continuing to come back in with the Ulcer Index. This is an end of day fear gauge, and it's above the moving average. And we're just a little bit below 20 with the VIX, both with the line chart. We did spend the opening part of the day above 20 with the VIX, but then we were able to close down below it. And we're still seeing we had seen a real pickup on Thursday with the VIX of the VIX, how fast the VIX is moving or the volatility of the VIX. It dropped down a little bit on a closing basis because we got back a lot of the gains, even though we gave up, or a lot of the losses, even though we gave up some of the gains. And we're still seeing a rise here with this fear gauge. It's going up. That means fear is coming back in. We're also going back up with this other fear gauge. So that's confirming that more fear is coming into the market. Tick down just a little bit with the daily equity put call ratio chart, but we're still going up with the 5-day chart, which is more negative, and the 10-day chart, which is also more negative. And we're seeing a drop off here. This is a high beta to low beta. Now, we haven't lost the bigger picture context, at least yet, where we've been positive. That's when the market's going up. But when this ratio is coming down, that's a market that's more defensive. And we're not really seeing much fear increase here. We're just at the high end of the band with the volatility risk premium. Then the advanced decline line still not breaking down, but not showing an awful lot of strength here based on price or volume. We did decline in the short term. We're actually below zero with the advanced decline ratio. We're still above zero with the intermediate term advanced decline ratio. Decline, but still above zero with our advanced decline oscillator. And still going up with the 5-day and 10-day, but you can see there's a drop off in the new highs, a bit of an expansion in the new lows. We're looking internally inside of the S&P. If we see the red really start to build and the green really start to go away or continue to go away, that means internally things are turning more negative, and it's holding up okay for right now. And then we're positive in the bigger picture with our smart money indicator here, the accumulation distribution. We're just barely above the moving average, but we're negative in the short term since we dropped below the moving average with the boom indicator, which is just a modified MACD indicator. I just changed some of the calculation numbers around. And we're negative here with the chicken money flow. The histogram is going down, and we're negative with the chicken oscillator. So all three smart money indicators are still negative. And we're negative with the vortex. The red line's going up, the green line's going down, the red line's on top. That's negative there. And we're seeing a bit of a deterioration here with our advanced decline line again. The NYSE common stock below the moving average, coming down a little bit above the moving average with the S&P, but now we're seeing more of a trail off with the mid caps and the small caps. And we went negative. Now we were still positive with some of our charts after Thursday. This is dropping below 50 now with the percent of stocks above their 20-period moving averages. It's been really choppy over the last few months. So we'll see. We could have an update on Monday and send this back above 50. But the bigger picture is you can see here's the high, a lower high, a lower high, a lower high, a lower high. Or we haven't really broken out of that pattern yet. And we're also back below 50 with the 50-period moving average study, 100-period moving average study. Even though we're declining a bit here, we're still positive longer term since we're above 50 with the 200 moving average study. So here is our chart where we did lose the 50-day moving average at the open, but then we got that back and we were able to close above it. So that's holding up for right now, and we were below average with volume. A little bit of a drop off here with our 20, 50, and 200-day moving averages on the S&P. This is one of the indicators that's showing short-term negative conviction, the Stochh RSI. And we're coming down, but we're not extreme with the Williams percent R, where we're starting to get extreme with the CCI 14. We're declining, but not extreme with the CCI 20. So if we see more of a downward move, expect these indicators to show more short-term negative conviction. And not really seeing much conviction here. Now more negative in the short term with the stochastics, coming back down and below the moving average with the intermediate short term, still negative with the long short term stochastic. And still below the midpoint with the force index. Still below the 10, 20, and 30 moving averages here. So that's more negative in the short term with the bow tie method. And still seeing some more vulnerability here with the short term trend. We're starting to see the green line and the blue line go down and prices below both of them. And we're below the simple and exponential moving averages based on 20 periods. So that's why we're negative in the short term. And we're still in the -1 channel. We started out in the -2 channel, but got back up to the -1 channel in Friday's session. Then intermediate term, balance of power, still looking more negative, below the midpoint and declining. And we're still positive here with the go, no go, with the darker blue bars, dropping below the midpoint, getting a little close to this red line, which is the lowest low value on this chart. Still positive with the proper order, still negative with the TTM squeeze, and negative and showing a little bit more conviction with the ease of movement. That's going down. The Arun's been on vacation for about a week now. It really hasn't changed. And this is what was holding up and was slightly positive after Thursday, even though it came down, it was still above zero, with the S&P McClellan oscillator. Now we've dropped below zero, so that's showing more broad negativity here. And so we're starting to go down with the summation index based on price and volume. So that's turning another primary indicator over to negative. And we already were negative after Thursday with the NYSE McClellan oscillator. Now we're just more so. So now we're going down with the summation index based on price and volume for the summation index for the NYSE. Okay, now for about a week to a week and a half, we've been seeing positive signals from the swing trading oscillator. They were going up even on down days. Now they're starting to roll over. So now they're picking up some weakness here. And this is turning negative after it had been positive, both based on price and volume. Still looking more negative overall with the momentum oscillator, the PMO, but we're rolling over, but not quite below the moving average based on price or volume, at least yet. So a little bit of a decline, slightly below 50 with the PMOs that are rising. The buy signals are starting to roll over, but we're still going up with the PMOs that are above zero. Negative with the Elder's Impulse system. Negative with the parabolic SAR. Negative with the short-term slope oscillator. Negative with the MACD, more short to intermediate term. So we're pretty much rolling over and looking negative here. And we never did really turn positive with our two long-term oscillators. And we continue to be negative with the Copic curve, another momentum oscillator. Dropping down here with the Sean trend meter, that's turning more negative. We're dropping below 50 with the money flow. We're still above 50, and we actually advanced a little bit with the ultimate oscillator. And we're declining, but we're still above the advancing moving average with on balance volume. And we're slightly below 50 with the intermediate and short-term RSI. And we came down just enough to cross below the moving average, and we're back below 50 with the bullish percent index. So this is looking more negative again. And we're just a little bit above 50 with the NYSE bullish percent index, but we're actually looking more negative here. The NASDAQ 100 bullish percent index below 50. It was trying to bounce back up here. Now it's declining. And seeing a bit of more vulnerability, but it's still holding up for right now with the intermediate term trend based on 50 periods. We are below the blue line and the red line. The longer we stay here, the more these lines are apt to roll over, but they're still pretty much flat. And we're holding at the 50 period simple and exponential moving averages. That's keeping the intermediate term trend positive. So we're negative in the short term, positive in the intermediate term, and long term. And even with the decline, we still didn't get down to this anchored weighted moving average here. So this is also another support level that wasn't really tested, but we still call it support since we haven't come down here and broken through it. It could end up providing a bounce if we come down to that level. And then those stocks above their 200-day simple or the Dow Jones Semiconductor Index, and it's still well over 100% above. I put this in a different spot, so that kind of tripped me up here. Um, we're still looking rather extreme here, and this is what we're watching. This is a weekly chart of the Dow Jones Semiconductor Index. It's coming down, but it's still above this blue dash line. And when we did get above this blue dash line, the 100% level, that's often where we saw more significant declines. Then we're dropping below the little mini rainbow here with our 20 period simple moving average of the open, high, low, and close. And we ended up being just barely positive. We were up 0.08% for the S&P for the week. This is still looking okay for right now. The weekly bars, for the most part, we didn't set a higher high this week, but we didn't really break much of this pattern of higher highs and higher lows. So that's still holding up for right now. And we're looking more negative with the Heiken Ashi. We're negative with the Kegi chart, negative with the Renko chart, negative with the three-line break. So now all four of our different trend-based charts are turning negative. And the open brought in a lot of circles down here. So the point and figure chart is starting to pick up some weakness as well. And then longer term, seeing a bit more of a tick down here with the 150 and 200 moving averages there. So we're negative in the short term with everything, and I have us negative in the short term here. So to me, all of these arrows should be down for the different stock indexes. And this really hasn't changed. We're still negative with bonds based on price in the short term. We're still looking at a possible improvement with the dollar in the short and intermediate term. And so we saw energy, which again, when the market starts to run into trouble, that's when energy starts to do well. And then in the weekend videos, in the intermarket analysis video, I compare it to the S&P. But we did see tech coming back up, and that helped things a little bit. Real estate bounced and utilities were up. Industrials were virtually unchanged, where we saw the banks getting hit a little bit here, and communication and discretionary, they ended up being down as well. So an awful lot of red. This all happened. You see 9:33 a.m. here. That was right at the market open. Awful lot of negative things happened with a BPI cross below 30 with the tech sector, a cross below 50 with the industrial sector. Then we just had a countdown here. NASDAQ 22.765. Then it got back up to 8. Then 22.9, 23. So this is more the bounce that came later in the day. Canada ended up having some problems there. We did cross below 6,700 with the S&P, but then we ended up getting that back. And we crossed below 48,000 with the Dow. And then we had a BPI cross below 50 with the NYSE, which has been one of the stronger areas of the market, and that's more broad based. So this showing some weakness later in the day. This is right a minute before the open, or excuse me, the close. And so this is a little bit of a concern to us here. So we did see a little bit of green here. That helped things. At least you had some folks coming in trying to do some buy the dipping here, but the communication didn't do very well. Financials didn't have a very good day. Tesla was up a little where Amazon was down with discretionary. And then we had the Dow still just closing a little bit above this pivot point here. And that's it's still maintaining a bigger picture positive stance as long as we're above this pivot for the month. If we drop below it, that's going to turn things more negative. And then we have the diamonds, which are now negative. And we're still holding on to the 50-day moving average with the NASDAQ, but we're negative with the Elder's Impulse system. Still holding on to the 50-day moving average with the NASDAQ 100, but we're negative with the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be negative, and we're holding out above the 50-day moving average with the QQQs, the ETF for the NASDAQ 100. Small caps, they were virtually unchanged on the day, but they wanted a rate cut in December, and now that it looks like that's not going to happen, or at least it's in doubt, then we see the small caps really start to underperform. The Russell 2000 still under its 50-day moving average. This is the other small cap index. Negative with the small caps with the Elder's Impulse system. Mid caps, which never have been really doing all that well here. Um, Still below the pivot. That's turning them longer term for the month negative, but still above this S1 support level and below its 50-day moving average. Negative with the Elder's Impulse system. The Wilshire also right back above its 50-day moving average. So you can see where this convergence of all these 50-period moving averages, they're holding to this point. We're also slightly above the 50-day moving average with the total U.S. stock ETF, right at the 50-day moving average with the FANG index. And these are the really big stocks. So Apple didn't really see all that much of a move there. We were up 1.37% with Microsoft, trying to get back up to its 50-day moving average. Meta was virtually unchanged, but it's been seeing some weakness under its 200-day moving average. And Google, it was down 0.78%, but it's still hanging on to a stronger uptrend here. Nvidia was up 1.77%, was able to get back above its 50-day moving average. Tesla, it was up, but it's still below its 50-day moving average. Amazon was down 1.22%, still above its 50-day moving average. And then Netflix, it dropped again here. This was looking so good for the last couple of years. This was probably the best looking chart, and now it's really not looking all that good. And then here's the Dow Jones Semiconductor Index. I showed the weekly chart before. This is the daily chart. We were able to get back above the 50-day moving average. So this support level is holding for now. And we came down to the 50-day moving average with the SMH Semiconductor ETF, and we closed up off of that. So you've got lots of confirmation, at least as of right now. Now, things could go kablooey on Monday, but as of Friday's close, intermediate term moving averages are holding up for right now. This is a newer chart here. This is looking at the correlation because what I do, and I mentioned this a few times, when the market's closed over the weekend, I like to watch things. Even when it's closed, I'm watching the futures, I'm watching everything else. Well, when the market's closed, even the futures are closed. They don't open till Sunday night Eastern time. Well, Bitcoin keeps going. And over the last few years, we've seen a pretty strong correlation between Bitcoin in red and the NASDAQ 100. And you can see Bitcoin's not doing so well right now. It dropped under 100,000 and it's seeing some pressure. And we see that the correlation, and this is shorter term, this is based on 10 periods. You can see that the correlation down here means that they tend to go in the same direction at the same time. If you have the ability to watch this, this is what I watch over the weekend. Everything else is closed, but I watch Bitcoin. And if it's starting to see some problems over the weekend, that might bode not so well for the futures when they open Sunday evening. It's not always a done deal, but at least it's something to keep an eye on. And then oil, it was up here. We're getting into the high 59s now. The dollar, it's not really doing all that much here, but it was up a little bit. And then we're going back up with the 10-year yield. We're going down with the 10-year and dropping below the 50-day moving average based on price. And our growth to value ratio is not looking really good here. Qs to S&P, not very good. Discretionary S&P, not very good. Large cap growth to value under the moving average. Below the moving average here with all three indexes now, large caps, mid caps, and small caps. Saw a little bit of a tick up with some of these, but not enough to really change things. And here's the Hindenburg-Ullman. Here's the criteria for that. We did see another spike. Now, there's a one-day lag here. So this is November 13th. We won't get November 14th until after Monday's close. But we're seeing a series of spikes here. We had the initial one back on October 10th, and now we're seeing more and more and more and more and more. Similar. Okay, are we getting ready? We don't know if it's going to happen or not, but we just want to be ready for this. We don't base everything around this and say, okay, go short, get out of everything long. No, we look for confirmation in other charts. Now, we are starting to see some weakness, but this is also giving us some concerns here because this happened right before the COVID crash. This also happened at the end of 2021 before we went into the bear market of 2022. We're starting to see a similar thing here. So what's our outlook? Now, Nvidia is going to report earnings on Wednesday, and that is like the event. So that's a lot of folks are really looking for that to happen. That's a big thing. And then we're negative in the short term. We're still positive in the intermediate and long term. I have no idea about the economic reports and then anything geopolitical that may happen over the weekend, any trade deals or any tariff news or whatever if that comes out, that might have either a positive or negative impact. And I'm not even updating this for right now because why? So, and now seasonality for November 17th, we are positive with the Dow and we're neutral to positive with the S&P and NASDAQ. We're going to be coming into options expiration week and going back to 1980, we're up 59% of the time and down 41% of the time. So we do lean more positive with options expiration. But be aware, the week after options expiration, we kind of see a flip-flop here. Actually, that's not true. We're actually still positive even after. Sorry, take that back. Usually you see a flip-flop. All right, and then we do see some positive seasonality here on the post-election years. I look at the green dash line, couple of days of some negative seasonality before we try to go throughout the end of the month here. November is supposed to be a really good time. This also shows positive seasonality. I just go through these really quick. Positive seasonality after the Fed makes a rate cut. Positive seasonality just looking at post-election years, going back to 1928, looking at all the different ways that November have performed. All of this is positive. We're just not seeing that based on price. And then I added this over here on the side because I get a few questions. It's like, why on this page are these colors different? If it's gold color, that's a primary indicator. Like these are the three smart money indicators. If it's white, it's a secondary indicator. I just use that to kind of, I don't make decisions based on that. I just look at it to see is that confirming or contradicting what we're seeing in the primary indicators. And then I have one that I call a non-primary indicator. That's the Swindle trading oscillator. Now, the growth to value, I just pretty much keep an eye on those, even though they're quite important. And the short term is we're negative. We're below the 200-day moving average with the S&P, and we're below the 50-day moving average with the discretionary to staples. Then you have the yellow one here, the Swindle trading oscillator, parabolic SR, which is primary, negative. The money flow, and then our momentum oscillators are just not really improving. They have a day or two of improvement, and then they continue to roll over. And then we're negative with both the S&P and NYSE McClellan oscillator and summation index. The ease of movement is negative, and then all the bullish percent indexes, with the BPI for the S&P being the one that I watch the most. The vortex is negative, and the momentum is negative for the NASDAQ 100, and we have additional spikes with the Hindenburg almond. Then over on the positive side, same thing here, same little legend on the side, where longer term growth, I have that in white. I look at it very heavily, but I don't consider it a primary indicator. The ultimate oscillator is still positive, and the financial sector is still in an uptrend, but for many, many months, and I dropped those charts. I'll show them over the weekend in the weekly videos that I do, but I'm just seeing the same thing over and over and over again. We're underperforming the S&P. And then the long-term special K chart. I have a daily chart and a weekly chart, which I'll also show over the weekend. And then here are the pivot points for Monday. They're available on my website. They're also available at the YouTube community tab. And I can't put them onto Rumble because I don't have the ability to post such things that way. So our conclusion right now, we're negative in the short term. We're still positive in the intermediate term because we're below the 20 period moving averages in the short term. We're still seeing negative momentum building, and we're starting to see a negative trend developing where we're still not trending in the intermediate term, but we're holding above the 50 period moving averages, but still some weakness is starting to come in. We're positive in the long term, and that so far hasn't really changed. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.